Okay, so I think it's really important if you are a trader or maybe you're looking to embark on a trading career that you understand what it is that's actually driving the markets that you are trading. Now, typically, there are two forces behind a price movement. First of all, you've got the fundamental analysis. That's basically they'll look at the macro picture, the big sort of economic picture, and then you've got the technical analysis, which of course is the looking back at charts and historical data and so forth. So in this short lesson, we're going to explore in more detail the fundamental analysis, the main macro drivers behind the markets that we trade. So buckle up and enjoy. Okay, so in this lesson, we're going to talk about the two different types of analysis that you can use when you're analyzing the markets when you are trading. Now, you've got the fundamental analysis and you've got the technical analysis, and we'll spend the next couple of lessons talking about those. Today, in this lesson, we're going to talk about the fundamental analysis. Now, what is a fundamental analysis? Well, certainly when it comes to Forex trading, fundamental analysis is basically the macro view of the economic standing of a particular economy. So we're basically pitching one economy against that of another economy, and an economic strength is normally measured by its currency. So a strong economy should lead to a strong currency. That's the basis of what we do here in Forex. Okay, so what macro news really does matter? Well, there's a whole bunch of information that's released throughout the calendar month, and us as traders, we are analyzing these weekly news events that basically give us clues as to the strength of a particular economy. Now, when it comes to Forex, everything basically evolves around the central bank. Now, the central bank in the UK here, it's the Bank of England. In the US, it's the FOMC, Federal Open Market Committee. More about that in a second. But the central bank are basically mandated to control two things. They're mandated to control inflation and to maximize employment, to create an economy with full employment. That's basically what they are commissioned to do by the government of the day. And in order to do that, they have various tools to their armory, various tools in their tool bag. Basically, monetary policy, that's basically the movement of interest rates. So they can move interest rates up or down in order to maximize employment and in order to control inflation. Now, most central banks around the world, they're mandated to keep inflation in and around 2%. Sounds a bit odd at the time of recording when some of the economies out there have inflation up there at 10%. But they're mandated to keep inflation around 2%. And they do that by moving interest rates. Clearly, if interest rates are going up, that basically means people are more encouraged to save their money rather than spend their money. If interest rates are coming down, basically people are encouraged to borrow more money in order to spend more money. And of course, the more you spend, the more prices go up. Basically, that is what inflation is. Okay, so rising interest rates normally means an economy that is strong, and it normally means the currency will also rise with interest rates. Clearly, if you've got a rising interest rate environment, it's better to invest in that particular rising interest rate environment, in the bond markets and so forth. Well, in order to buy the bonds of the rising interest rate environment, clearly you need to buy the currency in order to invest in those higher interest rates, get a better return on your money. So rising interest rates normally leads to a stronger currency. And of course, the opposite is also true. Falling interest rates normally leads to a weaker currency. And that's what we're doing as Forex traders. We're trying to pitch one currency strength against another currency weakness. One of the reasons why I love the Forex market is because it is two-dimensional, as opposed to just buying a stock and hoping it goes up. This is two-dimensional. You've got the strength of one and you've got the weakness of another. So what are the news events that really get out there that give us clues as to where the central bank may go, also give us clues to where the economy is heading? Well, the most important news event of the calendar month is unemployment. Okay, now in the US, the unemployment release is called non-farm payroll, basically everything outside of the agricultural sector. Now, the non-farm payroll news event is usually the first Friday of the calendar month, and it's at 8:30 Eastern Standard Time, which is 1:30 here in the UK. So why is employment important? Well, just think about it for a moment. If more people are employed, more people have jobs, that basically means more people are earning money. And if more people are earning money, it means more people are spending money. And if people are spending money, it basically means prices are going to rise. That's basically inflation. And we know the central bank is mandated to control inflation at around 2%. So if more people are employed, more people are spending money, up go prices, central banks may have to move interest rates higher, therefore the currency should go stronger. So we always look at employment as the first in the chain of events that leads to inflation or the lack of. Okay, so other news events that come out throughout the calendar month. As I say, we have calendars, then you can see what's out in the week and the month ahead. And traders are literally looking at these as they come out, and they buy and sell on the back of these news events. Average earnings, very important data release. Well, average earnings basically means, are people earning more money this year than they were last year? They have year on year and they have month on month releases as well. If more people are earning money, average earnings are going up. Well, it stands to reason they have more money in their pockets, means their spending power is better, means they go and buy more, means prices go up, inflation goes up, interest rates go up. You're getting the picture, I hope. Okay, retail sales. This is basically, are people spending their money on the high street, or are they spending it online? Are sales going up? If sales are increasing from where they were last year, it basically is an early indication that prices may rise, inflation may rise. And I think you're getting the picture. Inflation rises, interest rates may have to go up as well. Durable goods. So durable goods is basically the high ticket items, the white goods like your washing machines, the tumble dryers, your fridge freezers and so forth. Now clearly, if you are a household and you're confident about your job prospects, or your job, you're confident about the economy, you're secure in your day-to-day economic life, then you might go out and buy one of these white goods. You might replace what you have already. If you're vulnerable, if you think you might lose your job, if you haven't got a job, then you're not maybe going to be taking these high ticket items. You may wait until you have more confidence. So durable goods, the white ticket, the white goods, the items that you wouldn't normally buy each and every week, if these are pushing up, again, it's an indication of the health of an economy, a subtle indication. So we do love a durable goods number. Now here's one, Purchasing Managers Index, also known as the PMI data. Central bankers that decide interest rates love a PMI release because it is a forward-looking indicator. These other ones we mentioned here, durable goods, retail sales, average earnings, this is telling you what happened last month. It's looking back, it's lagging, Whereas the PMI, it's a forward-looking indicator. It's basically a survey for all the business leaders out there in the different sectors, manufacturing, services and so forth, basically asking them, are you confident about the prospects going forward? And anything above a read of 50 is deemed to be an economy that's expanding. Anything below 50 is deemed to be an economy that is contracting. So this survey basically gives us a clue on their outlook. And of course, if they are positive about the outlook, if they're giving a positive read, that basically means they're going to be maybe employing more staff. They're going to be investing more in plants and machinery. So it's a good forward-looking indicator. As I say, central bankers love a PMI release, so do keep an eye on that. Again, we discuss all these in our daily live stream, so it's well worth checking in for those. Now, housing data, new home sales, housing starts, mortgage approvals, all this is a good indication. Again, these are high ticket items. You don't go out and buy a new house if you're worried about your job, if you haven't got a job. You need to have confidence in the economy, you need to have confidence in your work and so forth before you start looking for these new purchases. Housing starts, are businesses building more houses? Are construction firms building more? Are they investing more? So you're only investing more if you're confident. So housing starts, big economic release. There's a whole raft of different housing data throughout the month. Do pay attention to that as well. Now, even if you're not trading the fundamentals, it's still worth knowing what is coming out in the economic front, because of course it does move the markets. Whether you're on it or not, it's irrelevant. Markets do move on these releases. You may have in your strategy that you don't trade just ahead of one of these big news releases, because sometimes the markets can be quite volatile. And they don't always move in the direction that they should do. Is it already priced in? We don't often know whether it's priced in or whether it's a shock or what have you. Then you've got the producer price index. That's basically what the producer, what the guys that are producing the goods and services, what their cost is for their raw materials coming in. If all their raw materials are coming in at a higher cost, well, they've got to filter that cost into the retail market, into us. That basically pushes up inflation. So it's a good sign that inflation is pushing up or not pushing up, as the case may be, by looking at what the producers are paying for their raw materials. Then you've got the gross domestic product. That's basically the country's bank account. You know, how wealthy is the economy. It's basically a good sort of measurement of the general standing of an economy. So the gross domestic product, basically how much the government, the country has in its coffers. Then you got CPI, Consumer Price Index. Well, that is basically inflation. That is the economic release that tells us what inflation is doing. The Consumer Price Index, consumer, that's you and I, what we're paying for our goods and services. And remember, the central banker, he's looking at that, and they have to keep that at around 2%. So that is the key important data that comes out once a month. CPI at the moment, the time of recording across the globe, because of the pandemic and because of the war in Europe, this has been rising quite considerably. In some countries now it's up at almost 10%. So it does sort of almost make the 2% target maybe insignificant. So those are the economic releases. As I say, even if you're not trading the fundamentals, you should be aware of what is coming out. Now, if you're trading the fundamentals in, say, the stock market, for example, you'll be looking at a company's balance sheet. You'll be looking at the sector in which the company is operating in. You'll be looking at the earnings per share and so forth. You'll be looking at all these fundamental views. The general health of an economy also is relevant to certain stocks as well. So the fundamental news is the big picture. So be aware of that. The fundamental news is the macro view. Okay, so these are the different central banks around the world that we really focus on. As you'll recall from one of the earlier lessons, we focus on the top 8 economies primarily. We can obviously trade the minors as well, but the top 8 economies are represented by the RBA, that's the Reserve Bank of Australia, that's the Australian Central Bank. You've got the Bank of Canada, the BOC. You've got what have we got here? We've got the Federal Open Market Committee, FOMC. You've got the MPC, that's the Monetary Policy Committee. That is the UK Central Bank. Basically works out of the Bank of England. Here you've got the Reserve Bank of New Zealand, that's the RBNZ. You've got the ECB, the European Central Bank, and you've got the Swiss National Bank and the Bank of Japan. Now, normally once a month, these get together and they decide on monetary policy. They decide on interest rates, but it's not only their decision, which this day and age is pretty priced in. They follow up with a statement afterwards, and they have a press conference where all the journalists ask the governors and the presidents questions about the general health of the economy and so forth. So it's not only the news release and the actual interest rates, but it's also the follow-on statement and the Q&A that you need to be paying attention to. And the other thing you need to consider is the forward guidance policy that they basically have, all seem to have these days. That's basically giving us guidance before the actual event. So these are the sort of governors of the central banks. Here you've got Governor Powell, you've got Kuroda in Japan, you've got Bailey out of the UK. This is Lowe out of Australia. Now, The forward guidance is basically something they've adopted really, I think, since the global financial crisis in 2008. They don't want to be shocking the markets. So you'll always see them on the news wires, always being interviewed, giving interviews to all the journalists, basically preempting the economic policy meeting, because they don't want to shock the market. So they plant little seeds, they give us clues. So they want to keep a stable market rather than shocking the market with interest rate rises or interest rate cuts. So the forward guidance, statements and meetings with these central bankers throughout the calendar month are very, very important. They are listed there on the economic calendar, which of course you can get here on the inside the trading room. You'll see the news releases covering all this, all the actual data and these central bank speakers. So make sure you check that out. And again, we cover it in our streams as well. Okay, so I hope you found that useful. Don't forget to leave me a comment here. Let me know if you think I've missed any really important bit of macro news out. Don't forget, of course, to subscribe to the channel if you don't already do so, and that bell notification notifies you, of course, when I release the next video. We're turning these out now at quite a pace. We're also live streaming pretty much every day of the week, but I do a big event on a Monday as well, 3 p.m. London time, that's 8 a.m. On the East Coast of America time, where we look at the macro view ahead. It's your chance to talk to me directly, live, one-on-one. Don't forget to follow us on all the socials as well. We do populate that with lots of content as well throughout the trading week. Don't forget, now we are a prop firm. We accept US clients as well on the new DX trade platform. It's going down very, very well. But of course, if you're outside of the US, we can still provide you the MT4 trading platform to access your props. If you want to go to the City Traders website, it's citytraders.com, and you can learn more about that and all our different assessments. I think it's fair to say we are about the only prop firm out there that actually provides the education and the community to really give you a chance at getting a funded account. If that's not your thing, I'll see you very soon in the next video. Have a good week.